All right, welcome everybody. We're very excited to be here today with a very special guest on a very important topic. First, I'm Michael Movitz, one of the co-founders of Brandjectory, here with my partners as usual, Tom Malengo and Susan Bryanton. And the topic and idea of raising capital through traditional investors and traditional methods is becoming much more difficult in the current environment. And there are lots of different alternatives and new ways to think about getting funding and different sources and ways to negotiate those deals that are more win-win for all parties and help to alleviate some of the concerns that traditional investors have with the current profile of early stage businesses. And so I'm very happy, we are very happy to be joined today by Elliot Begoun. He's a close friend. He is an industry leader of 30 years, an author, a brand advocate and champion, one of the most empathetic people I know, and serves founders in this industry with unbelievable amount of compassion, and is truly authentic and here to help all of you and the industry grow and thrive and survive. So with that, I'm going to hand it over to Elliot in just a second and let him introduce himself and take us through his presentation. But just very quickly on logistics, our housekeeping, after Elliot speaks, we'll take some questions. You're welcome to ask those questions in the chat function while we talk. And if you'd like to connect with Elliot afterwards, he can share his information as well. The session is being recorded, so we'll make it available along with Elliot's slides after the event. And so with that, Elliot, please take it away.
Yeah, well, thanks. That was a lovely introduction. I don't know who you were introducing because it doesn't sound anything like me. But I'll roll with it.
And he's humble too.
We were talking right before this started. This is something I'm very passionate about. So we'll say that if there's any way I can be of service or help, I'm happy to do so. I wrote in an article just this week that I find myself simultaneously terrified and optimistic, right? I'm terrified for those of you who are on the brink, on the precipice, because, it's hard, and it's particularly hard in this moment of time. I'm optimistic, however, because demand for what we're doing and what we're building in terms of the kind of products that all of you represent has never been higher and doesn't show any signs of waning. In fact, in talking with a lot of our retailer partners and data partners, there's just continued strength in this sector, and it's a correction maybe that has been overdue for a while, and the industry will fix this vacuum that is this space that's between brands getting to institutional capital and not, and in the long run, I think it's going to be healthier for our industry and healthier for all of you. But how the hell do we do it now, right? That's the thing, especially for those of you who need capital. And truthfully, if you're sub $5 million, it's harder now than it has been. And the vast majority of that capital that you really need is truly working capital. It's to fund inventory and receivables. It's to be able to withstand all of the deductions from our distributors and promotions and so forth, and finding a way to do that makes sense and that isn't either so prohibitively costly in terms of servicing it or so dilutive that it leaves you with little left to be able to build the business from there is the challenge. So I want to share with you some of the things that we're doing and looking through, and take as much time as we need at the end to answer questions. And then if there needs to be any follow-up, I'm happy to do that. I'll start with a PowerPoint. I hate PowerPoints because basically it gives you permission to jump onto your Instagram feeds or LinkedIn or do whatever, sleep. So stick with me if you can. I promise I won't spend too much time there, but it does help frame it and prevent any risk of rambling. So I'll throw up my screen here really quick. Okay. hopefully everyone can see it. I want to talk about alternative risk capital. And so everything that we're talking about here is risk capital. When you're at a emerging stage, all of the capital that you're bringing in is shrouded in risk. That's just the reality. You don't have tangible assets of significance that can be collateralized. You don't have, a positive EBITDA that you can point to usually, and certainly most of you probably don't have, free cash flow floating around. So it's risk capital, and risk capital always is more expensive capital because there's that risk associated with it. But we have a challenge in this industry, and just to out it, right? I mean, we have 18, I think in the last decade, something around 18 to $20 billion in market share has been captured by emerging brands coming from the top 25 CPG. Yet somewhere in the neighborhood, I think Nielsen's latest estimate that I saw, something around 84.8% of brands that start in this industry are gone in 2 years. And that's not because 84.8% of them suck. Okay. It's not because 84.8% of them have founders that aren't capable of building businesses or products that aren't appealing to consumers. The vast majority of the reason for that failure rate is cash, is running out of cash. And so part of the challenge is that the way we're funding most of you and the way we're structuring early stage brands is misaligned. And that's what I want to talk about, is this misalignment and how we fix it. First of all, a little reality check. Okay. 99% of the brands, 99% of you aren't truly venture backable. And that's not a judgment. That's not an indictment. That's just fact that as you stand right now, you can't demonstrate with a high enough degree of surety that you can deliver a 10x return. And that's what venture investing is all about. The true VC fund is looking for exponential growth and the potential of a 10x return, because only a very, very few of their investments do that. I think the last data I saw, and don't quote me on this, but I think the aggregate portfolio in our industry in total, it's only 6% of the companies that are responsible for 94% of the returns. So, or 90% of the returns. So it's pretty staggering. We're funding everybody like they're a rocket ship, when many of them and many of you are Toyotas, right? And again, not an indictment. It's just that if you're building a brand that can be, profitable, that can be self-sustaining, and that can, weather the test of time and get down the road, that's how you should be funded. And if you have that, 1 in 1,000 brand that is truly, truly disruptive or category creating, or that if you don't win the battle to be first, somebody's coming right after you. Okay. But the vast majority of you are building brands that are solving a problem, meeting a tribe's needs, wants, etc. And you can build a very, very viable business if you're funded and structured in a way that rewards that and encourages that. So if we look at the next thing right now, from an investor perspective, and this is where I think the biggest change has occurred, is kind of this awakening of our investors. First of all, for the last decade plus, I mean, certainly from 2008, but probably since the dot-com bubble burst, capital in this industry has been relatively cheap. Interest rates have been, very, very low. And so money's flowed in, and there hasn't been a lot of other places for that money to go other than the public market. Now we're seeing that change, right? Interest rates are such that an angel investor, a family office, high net worth individuals, they can sit on that money, park it somewhere, and get a reasonable return. So it's making them a little bit more conservative in the deployment of it. But the other reality is that we've seen this kind of slowing or tempering of the M&A activity on the top side. We saw a lot of M&A activity, 5 years ago, a lot of big numbers purchased from companies that had no positive EBITDA, just were growing, but many of them didn't succeed. Many of them have been regurgitated. Companies have wound up back in the hands of original owners. I think of things like Honest Tea and Crave Jerky and things along those lines. Here's the reality. The way we're going to most of our investors today is binary. By that, I mean, let's say, the vast majority of you are probably going to be raising using a SAFE or a convertible note, maybe some of you equity, but let's just say a convertible note. If I'm that investor, I need 2 third-party things to happen for me to have any hope of ever monetizing that investment. The first is I need you to grow your business fast enough and quickly enough to be attractive to institutional investors who are going to meet the qualifying financing threshold to convert my note into equity. So I need that to happen. And then the second thing I need is for you to continue that rapid growth and to be attractive to a strategic, acquirer, to a PE fund, to somebody who's going to, potentially buy the business, at least make a significant majority investment in the business, and give the early investors the opportunity to take the money out. So those are the 2 things that have to happen. Both of those things are completely beyond my control and to a degree beyond you as the founder's control. And if those 2 things don't happen, I get nothing back. It's binary. And if you look at the most frequent return, using a statistical term, the most frequent outcome of a return in this industry, it's 0. So we've created this win-lose environment, right? Where we see a few successes that offset all the losses. But yet that's why we have that failure rate of over 80%. So then if you look at what this incents us to do as founders, the behavior that comes from this, when you take money from funders that expect venture returns, it results in misalignment, okay? Because what is best for your business? Maybe saying no to certain new distribution, like going into Stop and Shop may not be the best thing for your brand, or going into 100% of Sprouts, or going global with Whole Foods, or spending, more on customer acquisition on online just to drive top line revenue. If you have this misalignment where the expectations are for exponential growth when it's not in the best interest of cash management and building a resilient business, then you just risk doing damage to the business. The focus becomes growth for growth's sake. And so when you are misaligned, and this is what we've seen in the industry significantly, is that we build brands, but we don't build businesses. Okay, we build brands that are that have a good following, that have good social following, that have cachet, that is buzzworthy and so forth. But if you lift up the hood and look in, what you see is scary. You see this house of cards. And so many of you are built on that. And again, not an indictment, just a reality of the way things have been, that if one of those cards gets pulled, the business falls. My article this week, I called it Funding Frogger, which, may date me from the old 80s video game, but that we've been for years jumping and leaping from lily pad to lily pad, jump, raise the money, grow as fast as we can, jump to the next one. But now there are fewer lily pads further apart, so time to swim, right? That's kind of the mindset that I want to share with all of you. So I want to talk about structured exits. So everything I've just described is they're not structured exits. So they're requiring, they're dependent upon those things I mentioned. Structured exits are what we call self-liquidating, right? And what that basically means, structured exits are investments designed to achieve a return for the investor without a reliance upon a traditional exit. So I don't need, if I'm investing in you, I don't need you to raise a round to monetize my investment. I don't need you to exit your business to monetize my investment. All I really need you to do is build a good business and be smart about it if the terms are right, okay? And my hope is not, I want to be clear in this, that many of you may find yourselves down the road as a Toyota and then realize, wow, holy crap, I do have the potential to be a rocket ship. But it's very difficult for you or an investor to ascertain that early. The best thing you can do in building your funding and the way you build your structure is to get to bridge to what I would call optionality. And, if I were to put kind of numbers on that, that's, when you're maybe doing $5 or more million in revenue, where you're EBITDA positive, or at least really clearly, going in that direction, and your cash flow neutral or positive, then you have optionality. Because if you're there, then you can step back and go, yeah, my business, it does have the opportunity here to really explode. I can do it. I can platform. I can get into other categories or channels. I'm going to jump in with venture dollars and let's go. Awesome. And I think that's great. But you also may recognize, no, I don't have that, or I don't want that. But now I have potentially commercial banking available to fund my business. I may have PEs interested in coming in and taking a significant stake. I have options. And that's what I want you all to consider, is what bridges you to optionality. So let's talk about types of structured exits. And this is where we get into the weeds a little bit. And I apologize, and I will try not to make this too dense or too much like melatonin. And then, I can answer any questions as they come up, or we can do it at the end. But the first structure I want to talk about is the CARE. And this is something that we developed open source, no pride of authorship or ownership. We're just trying to get templates and structures out there to elicit this conversation between founder and funder about, how do I unlock your money as a funder to grow my business and return it to you in a way that you feel good about, without it, having to be dependent upon me building or doing things that aren't in the best interest of my business or the best interest of what I want for my business. So the CARE, which stands for COGS Agreement Retaining Equity. Very simple. What that does is it uses a percentage of COGS that is paid quarterly until an express return is achieved. And it includes a warrant provision. So let me put dollars onto it and just tell you at a 30,000 foot level. It's a very simple instrument. It's meant for brands that are really trying primarily to bring in working capital, have good fundamental unit economics, reasonable margin, not a huge cash burn, but just need money to be able to get over the hump. And maybe it's to support a rollout, maybe it's just to bridge to the next round. So let's use in this example an investment of $500,000. So an investment of $500,000 can be from a single investor, can be from a group of investors. $500,000 investment, and then what we would negotiate between the founder and the funder is the expressed return. So, depending on the perceived risk and depending upon the length of the anticipated repayment, that kind of dictates where that negotiation is. I would estimate that the average would be somewhere around a 1.5x to 2x return. So for simple math purposes, let's just use 2x. That makes it easier on me. So investor invests 500, they'll get returned $1 million. Okay. Then what we agree to between funder and founder is a percentage of your aggregate COGS. So this is based on accrual accounting, not based on what you manufacture, but based on what you sell. So we agree to 3% of COGS. Okay. Then what will happen is that every quarter, you take your total COGS that you have sold, the value of the COGS that you've sold, and you pay me 3%. And what that ensures is that the delta between revenue and the cost of this capital always remains the same. You're never, which is so often for early stage founders, a challenge when you use things like this, you're never out in front of it where the cost of serving that capital is much greater than your revenue can support. That relationship always stays constant. So as the business grows, the payment grows, but the relationship always remains the same. And so the business can grow into that payment. So you continue to pay that investor that 3% of COGS until that expressed return is achieved. There are a few other nuanced things to discuss in there, but I'll skip those. The only other important one is warrant, a warrant provision. So in a care, there's a provision for a warrant that can be issued up to 100% of the invested amount at an agreed upon fair market value. So let's just use 100%. So I'm the investor. I'm going to 2x my money. You're also going to issue me a warrant for 500,000 at what we agree is a fair market value for the business that I have the right to exercise as long as the care remains in effect. So if 2 years down the road, 3 years down the road, you've been paying me, I feel really good about our relationship, and the business is starting to show that this could be the one, this could be the business that could be the rocket ship that could bridge to that or is moving in that direction, I can take that warrant and exercise it, which would require me to write you another check for $500,000. And I would get a return of that, the equivalent common stock shares at that pre-agreed upon fair market value. So I'm locking in that fair market value today as we start the care and reserving the right to invest in you later. So that's a care. The next one is revenue-based financing. This one we're not building a template on. It's been widely used, probably most popularized on Shark Tank by Mr. Wonderful. And it's very basic. It's capital from investors who just receive a percentage of the ongoing gross revenue or a royalty rate until the agreed upon money's returned. I don't love this one as much because it puts the emphasis back on revenue. And anytime we put too much emphasis on revenue, it's everything underneath the business that sometimes gets deprioritized, and that can be a risk. The next one's a variable-based convertible note. This is another one that we're creating. We'll have a templatized term sheet to be shared with anybody shortly. We're just finalizing it. But it's this one helps kind of bridge the in between for funders and founders, because we're all very conversant and comfortable with a convertible note. The way this one works is slightly different though. So it's similar in a way to revenue-based financing, but it has an option to convert the remaining obligation if there's a qualified financing. So again, let's use real numbers. I invest that $500,000 and we agree to what is called a principal multiple of 2x. And then we attach a variable. So that variable can be a percent of COGS. It could be a percent of EBITDA. It could be a royalty rate. It could be a percent of revenue, but some variable. And you'll pay me that variable payment on a quarterly basis and reduce the obligation. So $500,000 gets reduced. However, at the time of a conversion or maturity or something, the remaining obligation is multiplied by that agreed multiplier. So if it's 2x, let's say you've paid me 100,000 back, so there's still 400,000 outstanding. That is multiplied by the 2x that we've agreed to, 800,000. And now that 800,000 can convert into whatever class of shares you're issuing at whatever share price, without any discount, without any valuation cap, because you've already grossed me up. So I'm already using that multiplier to do that. It just converts in that way. So very standard, very simple, but I don't need you to do that to get my money back. If you never have a qualifying financing, I'm still going to get my money back because it'll double at maturity, and then you're going to pay me there. And the last is redeemable equity. Again, this has been something that's been used not widely in our industry by any stretch, but it's not uncommon for early stage. I actually really like redeemable equity, and I'll talk a little bit about the way it can be used and the various ways you can look at it. So it's shares purchased by the investor that the founder can repurchase at a specific multiple or price. So again, using our same numbers, I buy $500,000 worth of shares from you, and at $10 a share. So I get 50,000 shares. We agree that you can buy a percentage of them back. Let's say you can buy 80% of those shares back within 5 years. Okay, at $20 a share. So I would 2x 80% of that money. And the rest of it, I continue to own because that's my participation in the potential upside. So I still own 20% of the shares I purchased from you, but you have reclaimed 80% of those shares at a reasonable return for me, but certainly less than it would have been had you had to buy them back at the end of the run. And this is where you can add some nuanced treatment to that. You can just wait and just say you've got until year 5 to buy those shares back and do it as a lump, or you can attach a variable, or you can build a payment schedule. So you could do the same thing, 1% of revenue, 3% of COGS, 10% of EBITDA, whatever that number is, goes to buy those shares back over that period of time, or it's a payment schedule, no payments for the first 6 months, but then you're going to pay me X per month until you purchased your 80% back. So I think it's a very straightforward way to do it. It does necessitate, putting a valuation on the business. But as an investor, to some degree, you've got a little bit of collateralization in the fact that you have the ownership shares. As a founder, it's anti-dilutionary, right? So your early equity is the most expensive equity, and now you have a path to buy it back at a very reasonable price, and then either keep it or redeploy it, selling it at a much higher price to the next investors that come in without it being so dilutionary to you. So I'll stop because this was super dense. I'll turn off the screen so I can see you. And I'm really happy to answer questions on any of this. And please, no question is too technical or too foolish. If I don't know the answer, I will find it out for you, but happy to offer what I can.
I think I'm sorry, go ahead, Brian.
Oh, I was just going to say, of all the structures that you just presented, are you seeing one more commonly adopted than the other?
Well, I mean, the CARE is the one that we had put out first, and that's being used most readily thus far because it's just so easy to execute and digest. If I were to bet, I would think the one that will get used most commonly will be the variable-based convertible note, because it's a bridge in between the familiar and it's simple to administer, and you can comfortably probably take more money that way. But all of them do the same thing. The one that I think has been used the most prior has been revenue-based or royalty-based financing, which I think is there's no provision for upside for the investor. So the key point to all of these is all of these don't need an exit or something along those lines for an investor to make it, but all of them, except the revenue-based, have that upside potential for the investor. So they're not making a decision to not participate in the upside. They're just not reliant on it. And all of these mean that the chances of putting a 0 on the board is basically 0. You're going to get some payments back. You may not win all of them, but you'll get payments back.
Gotcha.
I think implicit in that is that you have to have the revenue to service those structures, right? Or I'm sorry, the free cash flow to service the structure.
Yeah, I mean, yes and no. The way hopefully the money creates the cash flow to some degree, and then the revenue starts building upon it. You need the unit economics to do this, right? You need the economics to do it. The good news is that, again, the way let's use the CARE as an example. If you're early stage, maybe you're $1 million run rate business, so you're going to do 250,000 in sales in a quarter, and let's just say your COGS are 50% of that 125,000, then you're only paying 3% for the entire quarter of that 125,000. So it's not a big payment. Whereas if you were to have done it straight venture debt or asset-based lending, you're probably paying more than that every month. And so it allows you to grow into it. But when that $250,000 revenue rate becomes 2.5 million, then you're writing a much bigger check, but you're still keeping that relationship the same. And all of these, by the way, do have provisions for allowing early payments. So if you do raise more money or do get commercial lending, you're able to retire these risk capital instruments without penalty. And in particular, speaking to the care, an important other call out is that it is subordinate. So it's subordinate debt, it's non-secured, it's not senior indebtedness. So it does also allow for you to bring in, asset-based lending or factoring or things along those lines.
I think there's a question in the chat.
Yeah, I'm looking at that one. Is there a gross margin consideration? I mean, it's very category specific, but it only makes sense if your margins make sense for your category, right? So if you are, and in particular, I'd say, looking at contribution margin, if you're operating with very, very lean margins, then the care is probably not the best agreement for you to leverage. If you've got margins, gross margins in the 40s, then your COGS payment is 3 to 5%, the business can probably absorb that for the cost of capital. Because if you think about bringing in any of the fintech debt or any of the other instruments that are there, it's going to be more costly than that. So the other thing that I want to call out is that this all is about giving you permission as well to slow your rate of growth. These types of funding encourage you to put profit before growth, right? So it allows you to say, no, you don't have to grow just to grow. You need to say no to the wrong opportunities and be comfortable that nobody's coming behind you, pushing you, saying, go faster, go faster, go faster. The industry wants you to hear that and does that to you. And it's very hard to step away. But in this space, the thing that you have to do is understand that every decision you make has a cash implication, really know your contribution margins, and really think about, what does saying yes to this mean? Why am I saying yes to this? Is it just to put a run on the board, or is it doing something that's meaningful for my business? And is it returning, capital to my business? And that goes for all the expense side of your business too. And we could talk about that, in depth. For example, marketing spend. I think a mistake that's made by so many right now is, taking their limited marketing budgets and spreading it across all of their business and wondering why they're not moving the needle, versus taking that same budget and applying it to the 10 most profitable outlets or the most profitable piece of business in a more narrow aperture approach, and returning results back to the business, hopefully profitable results to the business, slowing the burn down, and then also simultaneously using that to build an investable case, which is, I'll use retail as an example. I'm in 300 doors. I only had enough dollars to deploy my marketing plan in 10 of them. In those 10 doors, my velocity was 4 units per SKU per store per week. In the other 290, it was 1. If I can deploy this strategy in the other 290, this is what it would mean in incremental revenue right now. That's what I'm raising for. It becomes a very linear investable case. So when evaluating an investment, how quickly do you want to see cash positive? Great question, Patricia. I mean, again, it's investor by investor, case by case. Personally, I want to see that there's a real clear path to get there quickly. and I want to understand what it's going to take and why anything would be done that doesn't get you there faster. I mean, realistically, it's very difficult for a young brand to get to cash flow positive, very, very quickly, especially if you're in wholesale and all of that, because you're dealing with such a short or such a longer cash conversion cycle and so much dilution to that cash. But there has to be a path there. And you should know that path. And we've done some work with brands, for example, that I'll give you an example. We had a beverage brand that was trying to build their brand nationally, and it was going to take millions and millions and millions of dollars of capital to do it. And then we stepped back. They're self-manufactured. We stepped back and we drew a 500-mile radius around their factory and realized there were 40 million people within 500 miles. And if we instead focused on really just being hyper regional and being omni-channel, being in not only retail, but in amusement and travel and college, university, and corporate campuses and so forth, we could build the business to a much smaller number. I think we came to $15 million over the next 4 or 5 years, but the EBITDA would be in the mid-teens to high teens, and it would take only another $1 million of outside capital to get there. It's a radical different look, but it was a look that made a lot of sense, and that was a much faster path to cash flow positive. It's going to take a lot less outside capital to get there, and it's a much lower risk. Then, if you're a $15 million business with a mid-teen EBITDA, that's a good time to step back and go, now I think I can take this thing nationally, or I'm interested in taking it nationally. So what else?
I'll throw one out while we're waiting. Can you just talk about timing for when these templates will be available? And then secondly, and perhaps more importantly, how should founders think about bringing these up when approaching investor conversations?
So the CARE template is available today. So and Michael, I can give you a link to it, but it's also available on our website. So but I'll give you a link that you can share. And again, we are open sourcing it, so please feel free to pass it along. The variable based convertible note should be out by the end of this week or early next. We're just finalizing that, and then redeemable equity probably within the week after that. So as those come, Michael and Tom, I'll make sure that you guys have access to them and can share them within your community. I think that the best way to I was telling the guys before we started this that I'm trying to find every platform and opportunity to talk about it. This is a passion for me because I really feel like this is a window of opportunity to correct this misalignment and really help both funders and founders build better outcomes. So, and we've modeled this, and the kind of IRR that we see is attractive. And so part of it is going to be education. The way I think to approach investors is to not get too specific at the onset on structure, because that newness of structure may be enough to create some pushback or some wariness just because it's unfamiliar. I think it's about just reframing the conversation, which I also think is a real opportunity, because I see a lot of deals, and it's hard to discern one from the other when everyone is showing up with relatively the same kind of terms: convertible note, 20% discount, X valuation. It's really hard to do it. It's another way for you to show differentiation to an investor. So the way I would suggest sitting with investors is saying, listen, we recognize that the industry shifted, and we recognize as well that it's hard to identify if I'm a unicorn in the making or not. What I do know is I'm a good business in the making. I'm very confident in that, and I can walk you through that. What I'd be interested in having a conversation with you about is how I can unlock your money to use it to grow the business and return it to you in a way that excites you and still gives you a chance to participate in the upside, but doesn't necessitate, an exit or growth for the sake of growth, and also gives you confidence that you're going to get, quarterly cash flows and be taking risk off the table every quarter. Because that's, again, what an investor wants here is, every quarter that you write that investor a check, she's getting, risk removed from the investment. And then, one of the things that I've offered is, if you have investors and they, want to talk about the technicalities of it from a non-legal perspective, from a business perspective, from a finance perspective, I'm happy to be a resource. I talk to investors daily. So if any of you are going to be in BevNet, I'll be speaking there. So, Gil.
Yes. Hey, Elliot, thank you so much. So if somebody's at a pitch event or meeting an investor, without sounding wishy-washy, and, do you say, doing a convertible note raise, but I'm open to, either 1, 2, 3, or 4 that you just mentioned, or do you just select one? I'm thinking of doing a care note, and if that's not in their wheelhouse, you lose them. So what, without sounding, like I said, wishy-washy, what do you suggest?
I would suggest a great question. I wouldn't worry about being being wishy-washy. I would determine, do you want to raise, first of all, how do you want to raise? Do you want to raise, in a more venture mindset where, you are going to, where the investor's monetization is predicated on you having some type of liquidity event, right? If you want to raise on that, do it through convertible note. Or if you don't, then the way I would phrase it is, I'm interested in we're raising funds through a structured exit. So that's the generic term for everything I just shared with you. So we're
perking up more ears, do you think, amongst the investment community?
And I think now for sure we're interested in an investment in a structured exit where you will get quarterly payments from me taking risk off the table, and that your return isn't predicated on an exit. But I will make sure, but you will have participation in any upside as well. That's how I would phrase it. And then you can take it from there. So, but I want to be honest and say that, to the uninitiated investor, this is foreign. So you're going to have, it was an interesting conversation. I had a room full of finance people that I was presenting this to, and two of them, said, I'm trying to educate investors, and two of them came back to me and said, that's great, but they're not the innovators. The innovators are the entrepreneurs. So educate the entrepreneurs and let them go do that. Let them show up as the innovators, and they'll help get the investors through it. And so I'm doing both, but there is some truth to that. Investors are pretty dyed in the wool, and it's why we're seeing that the same kind of investment, even though the returns aren't there, are continuing. The same structures are there because nobody's innovating the structures.
Thank you.
Hang on, Brian. Patricia put another question. Are you also strategic or lead investors along with the care investment? You're talking about me specifically?
Mm-hmm.
We're so TIG Brands is a community of entrepreneurs, all different sectors. We have our venture community, which is kind of an innovative rolling fund that puts money into the brands in our community, but that's not our primary role. And then I do some angel investing on the side. So, but I'm an LP in a couple of funds and a venture partner in a few others. And as Michael knows, I'm also called into a lot of these conversations with firms. So, Brian, go ahead.
Yeah. How do you see this fitting in if you already have convertible notes in place? And then the second part, would institutional funding have issue with this structure being in place?
I've had a lot of conversations with institutionals. No, in fact, especially around the care, because it's non-dilutionary. No, it's just another form of bringing capital in. They can't. So the care, venture funds have what's called a venture exemption. It's a law that gives them venture exemption around capital gains. They have to invest those 80% of the funds into what are called qualifying investments that meet that venture exemption. The care falls outside of that. They can still invest, but they can only invest 20% of their fund dollars into that kind of instrument. The other instruments, redeemable equity, variable-based convertible notes, to our understanding, would meet the qualifying investment threshold. In terms of on the capital stack, the way I would look to answer the first part of your question, if you already have a convertible note, and this is, something to talk to an attorney about as well, and CPA. So, just disclaimer there. But the reality is, these would sit below those, right? Because those are convertible promissory notes. So they'll sit below those on liquidation preference. So if I'm a note holder, I'm not worried about that because it sits below me on liquidation. And the truth of the matter is, if by funding in this way, it's giving you more time to build value, shareholder value, or valuation into the business, then that's in my best interest as a note holder as well, because that increases the value of what will happen at the conversion event. So I don't think they'll have an issue with it, and it works fine. Overall, it's bridge it's a good way to bridge to rounds if you're going to do that, or bridge to banking, etc. The challenge with sitting with convertible notes on the books now is that you've got to decide what you're going to do about converting those notes. And that's a time clock that ticks. And that's one of the reasons I think these kinds of structures are better, because you've got a convertible note, you've got maturity coming, maturity date coming. Unless you've built into your note and an auto maturity conversion into common, then at or around maturity, you've got negotiations to take place to if you haven't converted yet, right? Because in theory, that note's callable. Very few of you are ever in a position to pay back those notes at that time. So the fulcrum is definitely in the favor of the investor for that renegotiation if you want them to extend the note and so forth. So that's just something to be cognizant about too. Get in front of that if you do have notes that are getting there. What else?
What about other instruments, more traditional, whether it's factoring, ABL, crowdfunding?
Yeah, I mean,
comment on any of that?
Yeah, we'll work on a lot of them. So I'm a fan of equity crowdfunding or community rounds, as we funders trying to rebrand it, which I think is actually a better way. Especially now with the new Regulation C changes that allow you to raise up to $5 million in that, $1,070,000 before you need audited financials, $1,070,000 you need reviewed financials. It's you can raise under your terms. They've eliminated all the cap table complexity because it rolls up to a single cap table entry. So I encourage any brand to consider that as part of their funding rubric if they have a community, because only about 30% or less of the investment actually comes from people already on the platform. So you've got to be able to mobilize your community, your tribe, to make that work. Asset-based lending is there. So asset-based lending, just to define it, is usually a revolving line of credit based on the average assets you have involved in your business, and particularly your inventory and receivables. it's a good solution. The two challenges, quite frankly, right now are that a lot of them have moved up market. So they're requiring you before they're ready to lend to have a much larger amount of inventory and receivables, recurring receivables before they'll fund. And those that are doing it earlier are doing it very short term, and it can be, the payment schedules can be particularly onerous. So you have to watch the fintech solutions for that. So if you have enough assets and so forth, asset-based lending, using an Ampla or a Dwight Funding or something like that's a great solution. Factoring as well. I mean, factoring is something. There is no one solution to this, and in fact, nowadays it's really about cobbling together the best solution for you, and just being mindful that every solution, whether it's the ones I've shared with you today or the traditional venture or asset-based or factory, every one of them has trade-offs, and it's knowing what those trade-offs are and be really clear about what those trade-offs are, and then deciding which of those trade-offs are best, most tolerable for the business. None of them's perfect. The single best thing to do is figure out how to be less reliant on funding. And one of the ways to do that is to slow down, and just be really, really okay with that, and not let somebody arbitrarily, set the timeline for you. Set the timeline. We did a workshop at the Natural Products Business School yesterday. It was titled, profit before growth and cash before everything. If you really start looking at your business that way, if you really start asking the question, through that lens, what's the quickest path to profitability? What's the quickest path, as Patricia asked, what's the quickest path to cash flow, positivity? The number one cash consumer is growth. Okay, so the faster you grow, the more cash you're going to need. So slowing your growth to conserve cash and thinking about it differently, and being less reliant upon all these fundraising mechanisms, putting all of that, into a lower level of priority is the ideal. You still are going to need working capital. Some of you are, the horse is already out of the barn and it's hard to stuff it back in. So, but really you can ask that question of your business and rethink things. And even if you're already, if that horse is already out of the barn, there's aspects of your business you can choose to harvest. You can let those go strategically instead of trying to prop them up just because you're afraid you're going to have a black eye the next time you meet an investor, and show up to that investor and said, I made a really calculated business decision because funding wasn't available and I wanted to be less reliant on funding. This was an unprofitable business that wasn't sustainable, and I didn't have the resources to support it. And if I allocated what little resources I had to that, I couldn't support the businesses that should. I made a business decision. And if that investor can't understand, that's a wrong investor for you anyways. So.
In the closing minute here, Elliot, if you want to just give folks, tell us about where they can hear your wisdom on an ongoing basis. You have podcasts, you have feature articles in different magazines. Where else can they read about what you have written and said?
Yeah, and don't believe a word of it, right? So we have a podcast, TIG Talks, that we tape it in front of a virtual audience of founders and let the founders dictate the questions. I send out a weekly newsletter. You can subscribe to that on our website, www.tigbrands.com. I write for New Hope and Food Dive and BevNet and others, so you can always catch it there. We're starting a new series, just open source series that we're calling Karmic Coffee. We're going to do it every 2 weeks and just show up and maybe invite a few of our industry friends just to sit on Zoom with a beverage of choice, just to answer questions and offer any advice or commiserate as necessary. And then, if you want to learn more about our community, I'm always happy to meet with you or share that with you too. So you can check that out. We're about to launch a new website. So overdue. Our website is so 1990s now. We're not as cool and hip as Brandjectory with their new logo and background. So.
Thank you, Elliot. Any final questions or comments?
Let me just jump
from
in
the
one
group.
other
Okay.
thing. We are accepting right now applications for a beverage cohort. So if you're in the beverage space, which I can at least see a couple of you are, beverage cohort's pretty cool opportunity. You get paired with about 10 or 12 of your peers. You'll have a mentor, industry mentor, then each of you will be assigned 2 of our advisors from our TIG collective that will meet with you bi-weekly, and then you have access to our online library of courses and weekly workshops and so forth. So if you're interested in learning more about that, ping me too. So
Wonderful. Elliot, this has been incredibly insightful and informative as always. Thank you so much for
Elliot.
very welcome. And
Thank you so
please,
much.
like I said, passion project, if I can help any of you, feel free to reach out.
Thank you, Elliot. Thank you, Michael.
Thank you, Elliot.
Susan.
All right, guys.
See you, Brian.
Have a good day, everybody.
Bye,
Bye,
Patricia.
everyone. Thank you.
Bye-bye.